I hope you can hear me. Put couple of you confirm the audio level, please.
Yes.
Okay, thank you. Okay, welcome to our usual class on the business mathematics and statistics. Uh, Today we are continuing our last week session on the introduction to modeling. We got a detailed introduction as to some applied aspects of the business mathematics and statistics. More or less, we learned some of the widely used models like depreciation, demand and supply, break-even analysis, so on and so forth. And I think we managed to do a couple of questions, and I have extracted all the relevant exam questions for the continuation of the today's discussion. So what we'll do is we'll quickly take a little time to brush up our knowledge on what we learned on the last week. Uh, not more than a couple of minutes actually, and then we will focus on all the different styles and types of questions, which is the continuation of the last week. And hopefully I want to find a little extra time, maybe at least a half an hour today, and we are going to start the next lesson also, that is the time value of money, an important concept. I may spend at least 2 classes over there. So my plan would be to, maybe cover the time value of money, then maybe discuss with some adjoining theories like the treasury bond bill calculation, and maybe the portfolio theory also. So all these last couple of sessions are more or less from the theoretical perspective. They all are integrated, and if you even look at the examination questions, you will find a lot of similarities in the style of question. I mean, all the applications of the finance aspect, like for instance, if you take a treasury bond calculation or a discounting calculation of a treasury bill, so you might find this similar concept of the time value of money being applied, the present value future value concept. And what we are planning to discuss on the last theory area would be the portfolio theory. So the portfolio theory is nothing but a mere bunching or taking together a couple of different asset classes like treasury bills, bonds, equities, and fixed deposits and corporate debentures, and then try to understand what is the total return of that particular portfolio. So from that angle, testing the theories of the portfolio theory itself is a very detailed subject area in finance, but for the purpose of our discussion, we will just have a very brief overview on what a portfolio is and how do you really express the portfolio in a graphical perspective, and then how do you calculate the total return or a weighted average return, or you might find a particular asset classes weight is going to slightly change, like what we learned in the indexing area. A portfolio is a basket of items, and then over a time period that basket will grow or will grow high or grow to a lower level. So you will effectively need to understand how to calculate the new weighted average return of the portfolio. So my plan would be to finish up the theory area on the net present value, and if I think it is really comfortable to you, let us discuss all the other theory areas on the portfolio theory also with the treasury bond bill calculation, so that we will take all the remaining questions together in 1 or 2 classes. So having said that, we will stick to the today's plan. We will touch upon all the questions on the modeling, different styles, different types of questions, a lot of different areas from the depreciation to forex calculation. But more or less, students, you will understand the fundamental is very simple. Rather, simple arithmetics is the only thing that you need to tackle up these questions. No big equations or models to be keep in mind. Okay, so we will continue with our discussion on the modeling, and then we will continue our past paper questions on where we stopped last week. Okay, right. So quickly touching upon what we discussed last week, we got a brief introduction to what a model is. So you all know it's nothing but a simpler applied statistical model which you can observe in a day-to-day basis, mostly in different domains like finance and business management. So the models that we are categorically discussing under this subject area is demand and supply, break-even analysis, and depreciation. Exception we are discussing some forex calculations also under this lesson because there are no any other place for us to discuss them. So the first model that we learned is nothing but the simple equilibrium between this demand supply. So we learned that the demand curve and the supply curve, downward sloping and upward sloping, will come to eventually an equilibrium point. And depending on the different factors that you can observe which can affect this equilibrium point, you may find this equilibrium point to move from maybe toward your left hand side, toward your right hand side, expansion. So it's just a matter of arguing what is going to happen to the supply and demand, and then try to come up with a new equilibrium point. Okay, so yeah, these are some of the widely observable effects on the equilibrium point: taxes, ceilings, flows, income level changes, substitutes, complement, good movements. So these can change the equilibrium level. That's all what we wanted to really discuss under demand and supply. So the second model that we discuss is the break-even analysis. Here we learned one of the important concepts in finance, that is at what level that you need to cover your fixed cost and the cumulative variable cost up until that point. So the point that we can find that your total costs are going to be equal to your total revenue, we call that point as the break-even point, or simplicity wise you can call that point as the no profit no loss point. So if you produce that much of quantity, let's say for example 5,000 units, uh, at 5,000 units you're not making any profit, as in you take out all the costs and then try to calculate what is remaining to you, to the business owner, as the accumulated capital. But there won't be accumulation of any capital because the costs is going to eat all your revenue. But when you move away from the break-even point, you can understand that you are going to make some profits. So the simple graphs that you can draw under this subject area on break-even is the quantity and costs to the two axes. So you take the quantity produced to the x-axis and the cost to the y-axis, then you can identify, irrespective of the number of quantities that you're going to produce, your fixed cost is always going to be a constant, isn't that so? So there are some theoretical areas like stepped fixed cost. Say for instance, at a particular, let's say at a certain production level, your fixed cost is going to be like this. But then after that goes, let's say, beyond 5,000 units, when you move from that point, you can understand that it is going to be going to another step. Maybe you need some more capacity, maybe you need some new machinery. Those are going to be fixed costs, not the typical recurrent expenditure. And then maybe at, let's say, 50,000 quantity, again you're going to incur some other level of fixed costs. So although we argue, students, that the fixed cost is going to be a constant, but in reality, in practice, you can understand, depending on the quantity that you're going to produce, your fixed cost can also be variable, but not like a variable like a y equals mx plus c kind of a relationship, but rather we call this as a ladder kind of a relationship, theoretically stepped fixed cost, STEPPED, stepped fixed cost. But for the simplicity's sake, for our learning purposes, we have to keep in mind that fixed cost is going to be a constant. But be careful in the questions. Clearly, unless mentioned, you have to take fixed cost as a constant. But provided that you're looking at a major expansion, obviously the examiner can give you a scenario where the fixed cost is going to be changed or increased now. Okay, so we need to understand where the fixed cost line is going to be. But the second part is a variable cost. So it is simply assumed as variable cost per unit is also going to be a constant for a certain amount of items to be produced. But similarly, unless otherwise given in the question, you have to assume that it is going to be a linear variable cost. So even if you produce 1 unit or 5,000 units or 50,000 units, the variable cost per unit is going to be a constant. But in reality, in practice, take a major manufacturing company, your variable cost is going to be also having some minor exaggerations, like the fixed cost example that we discussed. But again, coming back to our discussion, variable cost is going to be a y equals mx kind of a simple equation. And then we learn that total cost is going to be the fixed cost plus variable cost per unit. So it's a simple, nice parallel line, which is going to be parallel to the variable cost line. So this is all what you have to learn under the break-even analysis, the behavior of the costs. But hold on, this is not what we want to identify, but rather the break-even point. The break-even point is going to be uh, at where your revenue curve is going to be touching the cost curve. We learn at a certain level of production, your break-even point is the number of units that you need to take away all this red area. Those are the costs. And then when you move to the green area, from that units onwards, from this, this case, I think I calculated as 4,200 units. So when you move away from 4,201, 4,202, and then only students, your business is going to make profits. So the simple argument is at this level, your total costs has to be equal to total revenue. So if you take a bit of a shortcut to calculate the break-even units, this is the equation which you can take. That means the contribution, we call it as a contribution, that is a selling price minus the variable cost. That portion has to be taken out by the fixed costs. Fixed cost has to be borne by the contribution that is going to be coming from the uh, selling. You sell at a particular price, that is a sell price here, and then you have the variable cost per unit. So sell price minus variable cost, this portion we call it as the contribution. So the simple argument is the fixed cost divided by contribution is going to give you the break-even units. That is all on the break-even analysis. And lastly, we discuss on this depreciation modules. Depreciation, simply we learn that you're going to have something called a cost for a particular item. So once you charge the depreciation, we learn that okay, depreciation is nothing but the diminishing of value, the wear and tear. If it is a typical kind of a fixed asset, be careful that for a current asset or a stock or some raw materials, you hardly find concepts like depreciation. But depreciation is typically being observed in instances where there is a fixed asset, kind of a motor vehicle or a machinery, plant, buildings. Those are the ones that you can depreciate. So once you apply this depreciation, what is going to happen? Your book value, the value that you record in your accountancy books is going to be diminished slowly by the depreciation that you're going to charge for that particular year. For instance, this example, you're starting with a 500 cost, and then after first year, you're going to charge 50 as the depreciation. So after 1 year, what is the book value? It is going to be 450. Second, another 50. So after the second year, your initial 500 cost, now we are going to record it as 400. Why? 100 worth of value has been diminished. Third, 350, and after 4, you're going to record that as 300. Okay, you're charging 200 at a row. So in simple terms, depreciation is nothing but you're charging some earmarked value from your cost over a period of time. There are a couple of methods that you can calculate the depreciation. The simplest one is the straight line method. It takes a simple straight line to take out the value of the cost. See the example that we discussed a moment ago. 500. So every year, this example, I am quoting as 100 as the depreciation amount. So what is happening here? The cost is going to slowly come down. Year 1, year 2, year 3. And let's say after the third year, you dispose this particular asset. That means whatever the selling price that you're going to get is going to be compensated with this 200 cost. Plus that value is your return at that point. Okay. So the depreciation expense you need to calculate. I mean, there are plenty of exam questions asking for this calculation. So for yearly, the cumulative, the total, it can be calculated in different ways. So the simple straight line method is going to always tell you, you divide the cost by the useful life. But hold on, if at all there is a residual value, what is this residual value? That is the value that you can sell this asset at the last point. So similarly like this, you can dispose this at 200 rupees. So you take the cost minus that residual value. That's an estimated value. Okay, that's a fictional value. You may get that value, you may not get that, but you need to have some estimate to depreciate, isn't that so? So you start with 500. You know that you're going to sell this asset at 200. Hmm? So eventually, what you're doing, you're going to depreciate 300 worth of value over a period of 3 years. So that's how you take this 100 rupee each as the depreciation. So this is the more simplest method. There is a more practical or a bit more widely used method compared to this straight line method. That is the reducing balance method. Here the difference is that rather you take the straight line, this is going to be a reducing balance trend. I mean, kind of a y equals ex kind of a trend, precisely 1 divided by ex kind of a trend. So here, the first year depreciation charge is not going to be equal to the second year one. Straight line method, we learned that, okay, if it is first year it is 50, then the second year is also 50, third year also 50. So no difference. But here, look at these values carefully. See, the first year depreciation charge, I'm asking you to only focus on this particular column. The first year depreciation charge is 50. Look at the second one, 45. Third one, 40. Even low, 37, 32 likewise. So what is happening here? Unlike you take the total amount of depreciation on a straight line basis, here what you're going to do is you're going to introduce this percentage. See, look at this percentage. Unlike a unique amount, a unique percentage will be charged. So whatever the cost or the book value you're going to have at the beginning of the period will be depreciated by that particular percentage. So that's why you're taking 500, 50%. Sorry, 10%. Out of 450, 45. So at the end of the year, the only difference that you're going to take away is this particular difference of the start value and the depreciation. For example, 500 minus 50 is going to be the 450, and that is going to be your beginning value of the next one. 450 minus, now it's no longer 50 but 45. Take that out, is going to be 405. So likewise. So this is much more practical, and in the first couple of years, you can charge a bit of a higher depreciation compared to the last couple of years. So it's a bit of a, I would say, widely used method compared to the straight line in the business nature. The depreciation expense per se, you can calculate by the equation that is shown here. You take the book value at the beginning minus the residual value. So this is the amount that you're going to depreciate into the rate of depreciation. So this is the total depreciation expense. So yearly depreciation, you have to do a small table like this. This is the easiest way to remember and calculate that particular amount. So an examiner can be a bit creative and ask maybe what is the depreciation charge for the second year. So you have to come to this particular point and get the answer. So it is going to be the charge for the depreciation for the second year is 40.5. Or there could be another question. What is the accumulated or the total depreciation for the first 3 years? In that case, you have to add all these three together. 40 plus 50 plus 45. 40.5, sorry. Okay. So that's about it, I think. All the theories that we discuss under the modeling. Right. So then I think we discussed some of the answers up until we discussed about this furniture manufacturing example. And then I think we discussed the lunch packet example also. Is it, am I correct to, yeah, this question also we discussed. I think we can start from this particular question. Yeah. Did we discuss 2019 March question number 1 also last week? I think this is where we're going to start, okay? Right, okay. Right, let's move on. We take out the question paper first. Right. In a shoe production company, so this is a compulsory question, and this is the first question of your exam paper. In a shoe production company, there is a linear relationship between production volume and production cost. Okay, linear relationship. The following information is available in connection with the company. So what do we have here? We have two levels of production. What are these levels? The volume at 65,000 and the volume at 190,000. And the associated costs are given. Okay, but what are these costs? We are not really sure. What is the expectation? The production cost for a production volume of 100,000 pairs would be. So the moment you see a cost structure like this, the very first question which is going to strike your mind is going to be nothing but where is the variable cost and where is the fixed cost? Isn't that so? So when there's a production facility being discussed, the key two items to be uh, taken out would be the fixed cost and the variable. But here, look at carefully. It's not the fixed cost, not the variable cost, just a cost is given here. Okay. So in simple terms, if you really look into this question, what is given here, this should be the total cost. Isn't that so? So the answer would be C. Let's see how you can get there. Okay. In order to save a little time, I've done my working so that I can share it with you real time. And hopefully, in case if you have not tried, follow the steps with me. In case if you have tried, let's see whether your answers are pretty much correct. Okay. So what I have drawn here, this is a simple volume and profit uh, graph that you can do for any scenario like this. So the fixed cost, I really don't know. That is what is meant here. Okay. The total cost should be what is given. Is that, I mean, am I going to draw another line like variable cost? I mean, there's no absolute point. What is the expectation of the examiner? Here she wants us to calculate the total production cost of the 100,000 pairs. Okay, so we don't really want to go into the detail of the variable cost, but rather first we will think that this is the total cost and we will derive from there. So what do we know? We know for a 65,000 number of units, the cost is 150,000. And we know for 190,000 units, the cost is 400,000. And the expectation is this middle point of 100,000. So I'm going to assume that, okay, since the question has given this linear concept, this has to be a linear, not a curvy nature like this. So I'm going to take this as a straight line. So in that instance, either I can use the trigonometry, or I can use the concepts of the costs and profit to find the answer of the missing piece y. We'll see how we are going to do this. So the first step would be, you can write this equation in any point that you're looking at a break-even analysis or a cost profit volume analysis. That is nothing but the total cost is going to be equal to fixed cost plus variable cost. The break-even analysis is the extension would be the total revenue is going to be equal to total cost at the break-even point. We'll see when you are looking at one or two questions in BEP. But here, the simple argument is the total cost is going to be equal to fixed cost plus variable cost. What can we write for the 2 points of 65,000 units and 190,000 units? We can write this nice relationship as for the total cost and the variable cost and the fixed cost. The first one would be this 400,000 is going to be equal to this total cost of 400,000 is going to be equal to this FC fixed cost. I have just denoted as FC. We don't know that amount yet. We don't know. Plus 190,000 units into the variable cost per unit. That of course we don't know. But here we can write 2 points of FC and VC and keep this equation aside. And the second, similarly, this for the second point also, you can write a similar equation. That is going to be the total cost is 150,000. There's going to be the FC. It's going to be the same. That's the important point. The same fixed cost plus 65,000 units into the variable cost per unit. Okay, so what have we done here? We have introduced two simple equations, hmm, parallel equations. You can resolve them parallelly, only two unknown variables, and luckily if you just take 1 minus 2, this what is going to happen for this FC portion, it is going to be taken out, isn't that so? 1 minus 2 from both the equations, both sides, this side is going to be 400 minus 150. So this side there is going to be 250 left. Isn't that so? What is going to happen to the other side? Here, these portions, these FCs that you see here is going to be taken off. And this 190 into variable cost per unit minus 65 into variable cost per unit is going to give you this 125 VC. Yeah, my math is correct. Is that 400 and yeah, it's correct. 125 VC. Yeah. Then eventually what I can calculate at the very beginning is nothing but the variable cost per unit, that is VC. VC is going to be 2 rupees per unit. Okay, now I know the VC. I can take any of these equations. This portion I know, and 400 fine, 190 fine, this I know. Then all what is remaining is nothing but this simple unknown piece of FC. Isn't that so? So easily I can calculate the value for the FC either from equation 1 or equation 2 by just taking FC to one side and take this all the numbers to the other side. Your fixed cost is going to be 20,000. Okay. So I think I have all the ingredients now to calculate this value of Y. Okay. So the total cost at 100,000 units is going to be again fixed cost plus variable cost per unit into this number of units is going to be 100,000. So simply this is going to be, now I have calculated FCA already, fixed cost. PC I know it is 2 per unit and multiplied by 100,000. Your answer is going to be 220,000. Answer C. So look at the effort that you, simply assume that for a moment you're going to face this examination in 2019 March. This is the first question. So I would say there are some couple of easy questions in this segment which you can, at a glance find the answer, but be careful. You have to do a bit of detailed calculations to get here. Are there any other shortcut ways? Of course, there are shortcut ways. If you're familiar with the concepts of this triangles to be resolved, you can easily find that there's a nice relationship here. Let me just show that also. The relationship is this particular portion of the triangle can be resolved in line with the bigger triangle. Yeah, so you can quickly write two equations, sorry, just one equation with the y value in it. How you are going to do? You can take this particular height and this particular height in one side. 400 minus 150 versus this particular height is going to be y minus 150. And similarly, you can write two more for this particular length and this particular length for the small triangle. The bigger length is going to be 190 minus 65k, and the smaller length is going to be 100 minus 65k. To resolve this equation, the y value is going to be exactly similar to that 220,000. Okay, so this is another method, an easy shortcut. Rather you take in the cost volume profit equations, you resolve these two simple triangles and get the value for this missing y. Okay, up to you, whichever the comfortable way you can keep in mind and follow at an examination question. Okay, we'll move on to the next question. If you want to interrupt me on any point, just be my guest. If you're not clear with anything, just pop it in the chat or use the microphone so we can discuss. Okay. If you're not, making any comments, I'm moving on with the questions because we have a lot to cover. Okay. Right. Okay. Simple forex question here. Part number 10, 2019 March question. First question, your compulsory question. Part number 10. Let's read the question. A fish exporter in Colombo has agreed to sell 1,000 kilos of fish to a US customer for 10,000 US dollars. 1,000 kilos, 10,000 US dollars. Okay. US dollar rupee exchange rate was at 1 to 165 when the transaction was agreed. Okay. Another data point. Last data point is USD to LKR rate had moved to 1 US dollar to 165 rupees when the payment was received. Okay. Carefully observe, there is only 2 points here. When the payment was done, the rate is 181. When it was been agreed, the rate has been 165. So what has happened from the exporter's point of view? He's going to get the same amount of US dollars. But if you really look into the rupee point of view, what he is going to enjoy? He is going to enjoy a small gain. Can you guess that? 181 minus 165. That is the gain that he's going to get. And exactly that is the expectation of the question also. Calculate the exchange gain or loss on the transaction. Simple calculation. This is the answer. So I just plot this graph for you to be clear what has happened over here. If I plot the time on the x-axis and the exchange rate of USD to LKR on the y-axis, what I can see here is that, okay, this is where they have agreed. And this is when the payment has been made. This is where they agreed. What has happened eventually? The rupee has depreciated or the dollar has appreciated. As a result, this 10,000 amount, 10,000 US dollars, is going to give a gain from rupee terms of 181 minus 165 into 10,000 US dollar for this exporter. The answer is going to be a gain of 160,000. Okay, fair enough. To discuss the forex questions under this area, I just want to highlight that I haven't seen much uh, elective questions in your exam paper, but rather maybe a couple of questions on the your first compulsory question. So that's why I just want to cover these questions under the modeling. I mean, there is no particular model for us to discuss here, but since I don't have any space, that's why we discuss. Okay, let's move on. Right. 2019 March, the same question paper, question number 6. Right. Now this is let me see. Yeah, question number 6 has a total of 4 parts. It's a very detailed question, I would say. If we discuss this particular paper, this part is also, sorry, yeah, this part is on the an expansion. So we are going to calculate maybe break even, cost, volume, profit kind of a calculation. So that's for a total of 5 marks. Be careful, 5 marks. And then in the part number B, sorry, part number 2, we're looking at a net present value calculation. You have to calculate the net present value. Part number 3, there's a probability calculation. So part number 2 is also a 2-mark question. Part number 3 also. We have done this part previously. It's a probability. And lastly, also there's a probability question. So I would say this question is going to consume a little time compared to the other questions. But if you really want to score some extra marks, and let's say if you're really stuck with maybe a selection, you're not really good at let's say a couple of areas, and you really want to score maybe at least 5 or 10 marks, I would say question number 6 is a good style to be selected, because you can maybe do a, allocate a little more time and score for a complete 5 out of 5 if you do one of these parts. Okay, so having that in mind, just for a 5 mark, let's read the question and see what's the expectation. Solve the following problems using the mathematical and statistical methods as appropriate. So this is applicable for all the 4 different parts of the question. We are still in the first part. A factory produces 2 types of plywood doors, normal and moisture resistance, or MR for short form, MR doors. The total cost, TC, of door production consists of fixed cost and a linear variable cost. Okay, we know that. Linear. So we have nothing to worry here. We don't have to write the assumption. The examiner has given it's a linear variable cost. So at whatever the number of units of production, we can take this the variable cost per unit is going to be a constant. Nothing to worry. The production and sales details of the 2 types of doors in 2018 are as follows. Okay, so we have the normal dose and then we have the moisture resistance, or the MR dose. What do we have here? We have the selling price per door in rupee terms, 9,000 versus 18,000. Fair enough. This moisture resistance feature is going to consume a little more money. And the cost structure, if you carefully look at, the cost is also going to be very high when you come to the moisture resistance doors. You're going to bear 15,000 versus 9,000 here. So selling price minus contribution, if you just do the math here, you're making 2,000 rupees of contribution by selling 1 unit of normal door, while 3,000 when you're selling a moisture resistance door. So the sales in 2018 are 18,000 normal doors and 5,000 moisture resistance doors. So this is expensive, less demand. So the number of units are a bit smaller. Sorry, the sales is going to be a bit smaller compared to the normal doors. So fair enough, good numbers. Further, fixed cost for the year 2018 was, now this is a good ingredient, 1.5 million. FC is going to be equal to 1.5 million. Right, now the scenario begins. I mean, carefully we have to read this and see the expectation. Let me go to the answer slide. Yeah. The management considers expanding the production of normal doors. This normal doors compared to this 2018, now we are going to go for an expansion. That means obviously buy some more capacity in the factory, maybe put up 1 or 2 more new machinery, go for an expansion. Using the factory space, which is currently rented out at a monthly rental value. You have to carefully read these numbers. Monthly. Now this you might miss. Monthly rental value of 40,000 rupees. Okay, that means the factory is having some spare space, and whenever there's spare space, what would be the let's say there's a small factory like this, and you're only taking this much of space, and this portion is rented out. Now what they are going to do is that they are going to consume that facility also, that green area also, and expand the capacity. Simple. But what is going to happen? Your rental income you're going to lose if you go for this proposal, and keep that in a corner of your mind. Let's move on. Under the proposal, fixed cost of production will increase by 500,000 per annum, and the variable cost of normal doors will reduce to 6,000 per door. Okay. Now what has happened here? It's a real case study. So under the proposed new structure, your fixed cost of production is going to increase. So that's fair enough, isn't that? So all these simple questions, you can take it as a fixed cost is constant, but the moment you're looking at an expansion, it is going to go for an expansion of the fixed cost also. So earlier, what was the fixed cost? It was 1.5 million. Now it's going to be 2 million. Add another 500,000 here, it is going to be 2 million. Moving on. And the variable cost of normal doors will reduce to 6,000. Reduce to. Now these words are very important. It's a very nice question, I would say. You have to be very careful. Reduce to. 6,000. Moving on, variable cost of MR dose will not change. Okay, so this 15,000 is going to be 15,000 itself, no changes. The selling prices of both those will remain unchanged. That's also fair enough. Although you go for an expansion, nothing going to happen to your market. So the selling price is also going to be constant. With the planned expansion, production and sales of normal dose are expected to increase to 23,000 dose. Now this 18,000 is going to increase to 23,000. Increase to. Hmm, Careful. So what's the new value? It's not 18,000 anymore. It is going to be 23,000. While the production and sales of MR dose are expected to decline by 1,000 units. So if what's the number here? Is it 1,000 instead of 4,000? Instead of 5,000? No. Be very careful of this wording. Decline by 1,000. So the new number of sales of the MR dose is going to be not 5,000 but 4,000. Very good question, I would say. The wording is being carefully used in a way that if you blindly try to extract these numbers and put up, you will get a totally different structure. So you have to be very careful. Okay. So let's see the expectation. For 5 marks, the expectation are like this. Calculate the expected change in profit due to this proposal. Okay. So we have to look for a profit computation, simple profit computation. So what is a profit computation? It's going to be the revenue minus all the costs. So you have the sale price and the previous number of units of 18,000 and 5,000, and then this new 23,000 and 4,000. At those two different levels, we are going to calculate the revenue on one side and then carefully the costs. What are those costs? It's going to be the fixed cost on one aspect and the variable cost on the other aspect. And then take the difference and see the 2018 model and 2020 model. 20, isn't it? Yeah, 20 model. The second part is the proposed expansion worthwhile. So obviously, for an expansion to be worthwhile, what do we expect? We expect some expansion of wealth or profit or any return. If that is the case, we can say it is worthwhile. But if it is the other way around, if it is a diminished or deteriorated, we can say it's not a good expansion. Okay, let's quickly go to my drafted answer in order to save time. Right. What I have done here is I have taken these two areas separately for this old structure and the new structure. So left hand side, you can see the old structure while the new structure is going to be on the right hand side. But importantly, since I thought that I'm going to miss out this point of the loss of monthly rental, I just put this on a side. The loss of 40,000 per month is going to be accounted for the new case. So we have to be careful. So all the other computation plus if you just miss this point, your number is not the perfect number. Okay, let's discuss these items one by one. So N stands for the normal, MR stands for this moisture resistance dose. So earlier, first we'll discuss the left hand side, that is a earlier one. So the selling price 9,000, 18,000 I've taken from the question. Variable cost 7,000, 15,000 I've taken from the question. So these two numbers are the contribution we discussed at the beginning. Contribution is nothing but the selling price minus the variable cost per unit. So by selling each dough, you're making 2,000 rupees as a contribution, 3,000 rupees as a contribution. That into the sales is going to be your total contribution. Total contribution. The numbers of 18,000 and 5,000 also taken from the question. So the total contribution for the old proposal is going to be 36 million coming from the normal dose and 50 million coming from the moisture resistance dose. So when I add these two together of 15 million and 36 million, I am getting a total contribution. Okay, so be careful of the wording contribution, not the profit, of 51 million. And what are the missing pieces? Now if I want to calculate the profit, I want to take out the any other costs. So whatever the variable cost, it's accounted here. I've taken it out here. Or otherwise, if you just take the profit separate, I mean the revenue separately, take out the variable cost separately, take out the fixed cost separately, perfectly fine. But here, I just want to follow this structure so that I won't miss anything in particular. Okay. Why? Because I mean, in the new proposal, you will see that some of the figures have changed carefully. So my numbers has to be perfect. Okay, fine. I have the total contribution of 51 million. Then I take out 1.5 million as a fixed cost. And then what else do I have here under this proposed model? Is nothing but the rental income. Per month, I'm getting 40,000. So if you carefully look at this particular model, this is a yearly computation. So all these numbers are yearly per annum for the year of 2018 versus for the year of 2020. So in that case, this green color highlighted monthly rental, we have to multiply that by 12 in order to take the yearly rental income for this particular period. Yearly rental income is going to be 40,000 multiplied by 12, that is going to be 0.48 million or 480,000. So this is a plus cash flow. I just take out the minus cash flow from the fixed cost from the contribution. So then eventually my profit of the older model is going to be 49.98 million. 49.98 million. Okay. So we'll keep that aside. That is the old story. You have the cost structure, you have the rental income, that's the old story. Now let's go to the new story of this expansion policy. What is going to happen? The question has said, okay, selling price, there are no changes. So this 9,000 and 80,000, no change. But now, because of the expansion, what has happened? Variable cost has reduced. See, it's no longer a linear one. But it's a good example. The moment you go for an expansion, you have the economies of scale, the scale advantage. You have some bigger machinery compared to you have a smaller capacity machines. Now you have quicker machines, maybe more efficient ones. So as a result, this 7,000 has reduced to 6,000. So since only we are focusing on the normal dose expansion for the moisture resistance dose, this 15,000 has remained same. So no change over there. So eventually what has happened to the contribution, so previously this was 2000 rupee contribution has now increased to 3000. It's a good thing. But for the moisture resistance dose, no change because of the selling price and the variable cost are the same. Okay, moving on. Now the sales. The question clearly says the sales has now changed. This 18,000 has moved up to 23,000, not by 23,000 to 23,000. So that means the new sales value is 23,000 units. And about the moisture resistance dose, maybe you're not focusing on that line. Maybe you're deploying your resources more on the normal line. So maybe due to different reasons, this 5,000 has now diminished to 4,000. So students, all ingredients are there for us to calculate the profit in this scenario also. So what do we see here? You have the similarly, you can calculate the total contribution. Now look at this value. This 15 million has reduced to 12 million. That's a minor change. But for this 36 million, it has gone to the staggering high of 69 million, close to 70 million. So altogether, this previous contribution of 51 million is now going to come to 81 million, 30 million expansion from the contribution. But hold on, is the cost structure same now? No, the fixed cost has changed. The question has said there's going to be an additional 500,000 which is coming to hit the fixed cost, maybe the factory, machinery, anything. So this 1.5 million is going to go to 2 million. And what is going to happen to this rental income? There is no longer any rental income figure. It's a null. So 81 minus 2 million, your profit in this scenario is going to be 79 million. Look at the expansion. When you do this 500,000 cost and you change the structure, this 49 million, approximately 49 million, is going to increase to 79 million, 30 million increase in profits. So obviously it's a very good worthwhile proposal because it is going to increase your profit by close to 29.02 million. Fair enough. I believe all parts are clear, but unfortunately, if you really look into this effort of doing this calculation, so since I have drafted the model answer, it's very easy for us to discuss. But if you really look into the time consumption, I would say you have to be very careful if you're going to select this question. You can have good scores, but be careful on the time. Okay, any questions so far? Right. Good. Let's move on to try a couple of more different styles of questions and quickly to jump into our discussion on uh, net present value and time value of money. Okay, I'm going to move to 2018 September question paper. It's a depreciation calculation, I believe. Yes. Part number 9 of your compulsory question. A machine costing 50,000 rupees at the start depreciates at 10% per annum using reducing balance method. Reducing balance method, not the straight line method. If it is a straight line method, very easy. You take 10% after 3 years. That means 50,000 from 5,000 at each year. That means 5,000 has to be taken out from this 50,000. Yeah. So your value is going to be 35,000. But is that the method? No. Using the reducing balance method, calculate the total amount of depreciation after 3 years. Total amount of depreciation after 3 years. Be careful on this question. See, there are two parts actually. Calculate the total amount of depreciation and what is the value of the machine after 3 years. Okay. The simplest way that I can recommend to tackle a question like this, a simple table. Maybe a little time consuming. Uh, Obviously, there are different methods. You can try out an equation also, but this is more clear and uh, you can find different answers if you follow this method. What is the value for second year? What is the value for third year? Cumulative first and second year. Likewise, you can find anything if you do this table. Let us discuss this one by one. So what do we have here in the first column? These are the year 1, 2, 3. The very beginning, the machine has cost you 50,000. So this is the brought forward or the starting point of any year. And the depreciation, we learned that it is going to be charged at 10% of your book value. So the starting point is going to be 50,000 into 10%. That is going to be 5,000. So as a result, your carry forward or the end value is going to be 45,000. How do I take this value? This is 50 minus 5,000, 45,000. Okay, so that value is going to be your beginning of the value, 45,000. Yeah. Then what is going to happen? Similarly, another 10%. You charge 10% out of 45,000. That is going to be 405,000. Sorry, 4,500 for the second year. You take this out from your beginning of the value. You're going to come for 40,500. And that is the beginning value of the next year. Take out another depreciation round of 10% out of this value. That is going to take out another 4,050. So take the difference between 40,500 and this value. You're going to come up for the last part of the answer. What is the value of the machine after 3 years? This is the answer, 36,450. What have we done here? From the value of this 50,000, we have taken out 3 depreciation rounds and we have calculated the estimated value of the machine after 3 years to be 36,450. And the part in this yellow highlighted, the total amount of depreciation after 3 years. Total amount of depreciation after 3 years, the summation, the sigma of these 3. is going to be 13,550. Is my math correct? Yeah, 550, and this is going to be, yeah, 13,550. Be careful, huh? You can, this question can be nicely put it in a different way. What is the amount of depreciation for the third year, and what is the value of the machinery for the after 3 years? So this part could be same, but for the first part, this may be the answer. Be careful on the wording. Okay, fair enough. Reducing balance method. Bit complicated, I would say, if you have to write this for the 5th or 7th or 10th year, but I would say you can tackle up any style of answer for if you follow this table. Let's move on. Right. I'm going to take 20 same question paper, part number 6. This is a similar style that we have seen in the previous question, where the question number 6 is going to carry some different subject areas under the same question. Solve the following that is applicable for all the parts, and let's discuss the part number 1. Lanka Pens Company records following revenue and cost figures in producing and selling 5,000 pens. At 5,000 quantity, these numbers are given. What is the revenue? 250,000. So you can calculate the selling price quickly. 250 divided by 5,000. Fixed cost are important figure. Fixed cost is given as 50,000 rupees. And variable costs are 125,000, right? So similarly, you take the division of these two numbers, you can get the selling price, and secondly the variable cost per unit. Okay, that's all we know for the moment. The first part, for 2.5 marks, this is the expectation. If 500 more pens are produced and sold under the same cost price structure, under the same, now this is the important part, under the same cost or price structure, calculate the increase in profits. Okay, fair enough, important. Second part, calculate the number of pens the company must produce and sell to break even. So this is simple break even style question. We'll discuss the answer. Right. The first part, surprisingly, I can come to this assumption. What is that? Since the same cost and price structure, the fixed cost can be omitted. Isn't that so? So what's the expectation of the question? It asks for the increase of 500 more pens. Calculate the increase in profits. Okay. So if you do a profit equation, the profit is going to be total costs minus, the total revenue minus total costs. So for this level of 5,000, you can say 5,000 into the selling price minus 50,000 minus variable cost per unit into 5,000 on one aspect. And similarly, 5,500 multiplied by the selling price, assuming this is the same price, 5,500 multiplied by the selling price, that is revenue on one aspect, and then take out all the fixed cost and then the variable cost. So the moment the students be creative here, it's been asked to calculate the increase in profit under the same cost price structure. So you can really do that equation and do it as equation 1 and equation 2 and reduce and take the deduct and take the increase, but rather forget about the fixed cost and you can nicely focus on the increased contribution. What is the contribution? It's the difference between the selling price and the variable cost per unit. So how I have calculated these 50 and 25 is simply by taking the division of these couple of numbers. You take the 250,000 divided by 5,000, that is the selling price, and the variable cost of 125,000 divided by 5,000 is going to give you this value of 25. So simply, the easiest way to get the answer for this question is to take the difference. This triangle is the delta, or mathematically it's the difference. So the difference of the profit of these two scenarios is going to be the difference of contribution, since the fixed cost can be omitted. So 500,000 is the increased number of units multiplied by selling price minus your variable cost. That is going to be 12,500. 500 multiplied by 25. Your answer is going to be 12,500. So be creative. I mean, since you are tackling up for marks and struggling with time, whenever you can save a little time, you can put up an assumption and focus on the big picture. The second part, calculate the number of pens the company must produce and sell to break even. Yeah. So here I just want to show you the two angles of using directly the equation of fixed cost over the contribution, or if you forget that, how to argue the same. Right. The first argument I'm going to bring in is at the break even point, we have learned the quantity of break even can be calculated as fixed cost divided by the contribution. So this portion of contribution, we have calculated it previously by taking the 50 minus 25, selling price minus the variable cost per unit. And what's the fixed cost? It's 50,000. So the answer is going to be 50,000 divided by 50 minus 25, or 50,000 divided by 25. Your break even number of quantities is going to be 2,000 units. So earlier we discussed that we are producing 5,000. So eventually that means we have passed the break even number of units and we are making profits for the company. So alternatively, if at all you forget this equation, there's a simple way to argue. I put it here also for your reference. So alternatively, at any point, you can say total revenue is going to be equal to total cost at a particular point. That any point is going to be equal to the break-even point if you write this equation with an equal mark. Eventually, your revenue has to be bigger than the cost when you're making profits. But at one particular point, that quantity, you can equate it at what point? That is at the break-even point. So I'm going to write this equation at the break-even point. My total revenue is going to be equal to total cost. So the quantity I don't know, this is the answer that I'm looking for. I have denoted as QBE, or the quantity break-even. So both sides of the equation I can now make it nourished. Total revenue, I know the selling price is 50, calculated previously. 50 multiplied by quantity break-even is the left-hand side of my equation. Keep it aside. But the right-hand side, total costs, I know the fixed cost is 50,000 and I know the variable cost per unit is 25. 50 minus 25, it's 25, and multiply that by the quantity break even. This is going to give me the variable cost portion. This is going to give me the fixed cost portion. And I have made the equal state y at the break even point. Only I can make this equal. Other areas I don't know. This could be bigger, this could be lower. There can be many relationships depending on your cost structure. So easily, now I have one equation, one unknown variable. QBE can be taken to the left hand side. So the left hand side is going to be 50 minus 25. Right hand side, I'm going to be left with 50,000. So then if I just take the QBE to the subject, QBE is going to be equal to 50,000 divided by 50 minus 25. So same answer, isn't that? So this portion is the shorter equation I have given for you to calculate the break-even point quickly. What is this? This is the fixed cost. What is this? This is the contribution. Yeah. So if at all you forget this equation, remember you can argue with your basics also. At the break-even point, your total cost and total revenue has to be equal. Yeah, fair enough. Shall we move on unless you have anything to ask? Okay. Same question paper. No, sorry, the next question paper. 2018 March. Question number 5. I would call these questions as very straightforward and very simple questions, but the moment you see these numbers of currencies and exchanges, you may get a little confused. But careful, read the question and see what the expectation. These are very simple questions per se, just to get a 2 mark. Let's go through the question. The following table equates 1 unit of each currencies listed in Sri Lankan rupees on a given day in January 2018. Okay, that means $1 is going to be equal to 153.8 rupees. Similarly, €1 190.2 and 1 GBP 216. Okay, that's all given. Now the question: assuming you have 100,000 rupees, you have 100,000 rupees. What would be the outstanding Sri Lankan rupee balance after payments of $35 for a book, €40 for a wristwatch, and $25 for a T-shirt are made online? Hmm? What is the expectation? You are given some foreign currencies to spend, and but you have rupees in hand. So eventually, you're going to translate your 100,000 into these values by applying these exchange rates. So eventually, you're going to burn out some of the rupees, and you're going to left out with some rupee value. So that's the number, other expectation for 2 marks. This is the answer. So at each different exchange rate, I can take the items value. So the book that I'm going to purchase is from the US dollars. So this multiplied by 35. This wristwatch from euro multiplied by 40, and lastly this T-shirt GBP, multiply that by 25. So when I multiply these numbers, what am I going to get? These are the rupee equivalent expenses for that particular day. So I take the sigma or the summation. This is going to be 18,391. This is my total spending. So I started with 100,000. Then I spent 18,000. So obviously I'm going to left with 81,609. Yeah, the answer is going to be C. Pretty easy, isn't that so? So the tricky part of the forex questions is sometimes when you see these rates and numbers, a lot of numbers, you tend to think that there are a lot of calculations involved, but merely the forex questions typically that you've seen so far in the exam paper are pretty much on towards calculating, maybe translating rupees to foreign currency or foreign currency to rupees, or maybe doing a translation between two periods and see whether there's a gain or loss, such kind of simple calculation. Yeah, let's move on to the next part. 18 March. So this is a simple appreciation depreciation. Very simple question again. 2018 March apartment Rajagiri valued at 25 million. This is 5% higher than the price paid for the same apartment 2 years ago in 2016. What was the price paid in 2016? So nothing but a simple appreciation. This value that you see here, 25 million, is going to equal to 105. And the value that is denoted as x in that case is going to be equal to 100 over 105 of the value of 25. The answer is 23.8 million. If at all you're getting confused, draw a simple timeline like this and do the math so that you won't miss any number to the opposite side. If you take 105 over 100, it's a different calculation. Obviously, there may be an answer also. Maybe this is going to be a similar for appreciation answer. Yeah, be careful on the numbers. Moving on. Same question paper, question number 6, part number 1. A similar style. This part is on the break-even and cost volume profit analysis. A printing company produces 80-page exercise books and sell them at 85 rupees per page. Be careful, this 80-page irrelevant data, not really helpful. Sells at 85 rupees per book. The total cost of production consists of a fixed cost of 7,500 and a variable production cost of 60 per book. Okay, fixed cost portion is clear. Variable production cost per unit is also clear. Yeah, simple calculations. Calculate the number of books the company must sell to break even. It's asking for the break even point. B, calculate the loss or profit if the company of the company if 500 books are produced and sold. Yep, simple calculations. We can follow the previous steps. Since we discussed a couple of questions, let's quickly look into the answer. Okay, at break-even point, now I'm going to use this old school method. Revenue is going to be equal to total cost. I know my revenue is going to come from this selling price of 85 rupees into this break-even quantity, which I don't know yet, this Q. Total cost is going to be coming from the fixed cost and the variable cost. So fixed cost portion is given 7,500. Variable cost per unit, uh, I know the variable cost is given as 60. Yep, multiplied by the production level at the break-even point. Yep. So this Q is going to be the Q at the break-even level. Hmm. This is the answer that we want to get highlighted. So I take the Q for one side. Q is here. So Q is going to be equal to 7,500 divided by 85 minus 60 is going to be 25 here. So the answer is going to be 300 units. So 300 is the break-even level. So the second part is going to be focused on calculate the loss of profit if the company is going to produce 500 books. Okay. So the answer that we got for part one is going to give us an indication it's going to be a profit. Yeah, because 500 is greater than 300 break-even level. So we are making profits now. So we can calculate the profit as taking all the revenue minus total cost simple equation. So revenue is going to come from selling price multiplied by quantity. This is your revenue portion minus 7,500 total cost minus 500 into 60. That is your variable cost. Sorry, the total cost is going to come from this is coming from fixed cost and this is coming from the variable cost. We see. Yep, do the math. You're going to get a profit of 5,000 rupees. Okay, fair enough. Now this is a pretty much straightforward, simple question for 5 marks, I would say. Not much detail computations. I think we can discuss at least another one or two questions before we go to the next part of our theoretical area. So we'll move a little bit faster. Right. This style of question we have discussed a couple of times, so let's directly discuss the answer. 2017 September question number sorry, question number 10 of your compulsory question. That's your part number 1. Yeah. The home appliance company Lanka Mega is forecasting sales for the next year. The world branch, okay, now these numbers are given. I have directly taken to the small table. The expectation is calculate the average sales growth expected in the next year. What are these percentage numbers given in the question? What are these? The growth of 6.2%, 9.5%, the 7.5%. These are the respective growths of the Gold, Colombo, and Gampa districts for the next year. So the simple calculation that I can do is nothing but take the current sales, inflate it by, grow it by the respective growth rates. 15.2 multiplied by 1.062 is going to give you 16.1424. Okay. So similarly, this is another increase 39.5 into 1.095. Careful with the calculator. Sometimes instead of 0.95, you may just put 1.95. That's a 95% increase. No, it's a 9.5% increase. So that means 1.095. Then these numbers are going to flow in this 43.25 something and this 27.41. So when you take the total addition of these three growths of Gold, Colombo, and Gampa, what do you get? You get the expected sales for the next year. The total comparison of 80.2 versus 86.8074 going to tell you that this is an increase of 8.23. Yeah. How do you get this number? Take the division between 86.8074 divided by 80.2 minus 1 is going to give you this number. Yep, there are different methods. You take 86.8074, take out by 80.2 divided by 80.2, it's the same thing. Yep, simple growth. Moving on. Yeah, with the availability of time, I think this is the furthest point we can come. We will discuss this question and move on to our next subject area for the next half an hour. But the next couple of questions, I really invite you to try on your own, similar to the previous discussions we had. There are a couple of interesting styles of questions. I want you to try it first, and then if you're really interested, I can share the drafted model answer with you. We will there was one question which I shared a model answer. I believe you may have got in the feed of your Google Classroom. Just go through that question. It's a very nice question on the GDP and the calculation of the consumer price index and some salaries of the employees, whether they have grown or remaining at the same level. Our discussion on the indices, a continuation. And it was a good question, I would say, because there were some couple of areas for you to think a little. GDP per capita and the population level is given, so you can assume that okay, if this is the GDP for a particular country and this is the population, you have to divide the GDP by the population to get the per capita GDP. So likewise, there are a few more nice common sense arguments for you to think on that question. So I have shared the model answer on your feed. Go through that answer and see whether you have any doubts. Yeah, so we will try to wrap up our discussion on the past papers for the area of modeling with the 2017 September. It's a complete 20-mark question. Now, I would say this is fairly good enough for you to try for the time and the effort that you're going to put in. But you have to have the detailed knowledge on the depreciation and the cost volume profit. So all are inclusive in the same question. Right, we'll go through the question. Number 7. A firm plans to start a tea packaging business and purchase a tea packaging machine at 3 million with an annual depreciation of 15%. So the capital cost is going to be 3 million and the depreciation is going to be 15%. Annual depreciation 15%. Okay. Important numbers. The firm plans to sell a tea packet of 400 grams at 500 rupees. And this is the selling price. Whereas each tea packet will cost 300 to produce. My variable cost is given as variable cost. They have told that it is a variable cost. And the fixed cost is also given at 250,000. Right. So the first part. Assuming the depreciation happen at straight line method of depreciation. Nice. So this is, see, although the percentage is affiliated with the question depreciation percentage, what is the question is going to suggest you? You have to take the straight line method as a depreciation. So how can you do that? But still it's the same thing. I mean, if you simply try to use the equation for the depreciation, it is going to be, if there is no residual value, your cost divided by the number of years useful lifetime. If there is residual value, you take the cost minus the residual value. Your cost is 500, the resale value is 200. So that additional 300 amount you divide by the number of years. But here the number of years are not given. Instead, an annual depreciation of 15% is given on a straight line method. Yeah. So that means approximately after 6 years and a fraction, your machine is going to get depreciated completely. It's not 15% every year. So first year 15%, second year another 15%, likewise. Is it from the reducing balance? No, on a straight line method. Yeah. So if you really do the math and take the precise point of the machine is going to end its useful economic life, that is going to be 6.67 years. So annually, each year, we are going to charge 15%. Simple. Calculate the total amount of depreciation and the value of the tea packaging machine after 5 years. Total amount of depreciation and the value of the machine after 5 years. Yeah. So easily, now we can calculate the annual depreciation. How we can do that? By taking the value multiplied by the percentage. So earlier, you just divide this by the number of years. Here, multiply this by the percentage. So this form is also perfectly fine. So that means each year we are going to charge 450,000 as the depreciation. So since it is on a straight line method, you can easily multiply that by the number of years to get the total depreciation after 5 years. Yep. So this 450,000, you multiply that by 5, you're going to get the total depreciation of 2.25 million for a total of 5 years. And the second part, we need to calculate the book value or the value remaining of the machine after the 5th year. It is going to be nothing but the difference between your cost and the accumulated depreciation. So cost is 3 million, accumulated depreciation is 2.25 million. What is the meaning of the word accumulated? It means the total. Year 1, year 2, year 3, year 4 plus year 5 is 2.25. That means your residual value is going to be 750,000. You charge another year, what is going to happen? You take out another 450,000 from this machine. So this particular number, there's a further discussion. This particular number, you take another 450,000. So your remaining value is going to be 300,000 after the 6th year. Now what is going to happen? Can you charge a full year depreciation? No, you can't charge. Why? For a year, you're going to charge 15%. So for this machine, after the 6th year, for the 5th year, it's fine, 6th year, it's fine. There's no 7th year, rather at 6.67, this is going to end its useful economic life. So this 300,000, this remaining is going to be exactly equal to, you take 450,000 multiplied by 0.67 is going to be equal to this particular 300,000. So the last year is not going to be a whole year, but rather a fraction year. Yep. Fine. Second part. Write an expression of total cost in terms of quantity of tea packets produced Q. Show the behavior of TC against Q and FC against Q in the same graph. Okay. So simple. So the first part is going to be write an expression for the total cost in terms of the quantities. Okay. So sorry, I think I have not written it here. The simple relationship is going to be, there are only two relationships in this calculations. Either you can write the total cost is going to be equal to fixed cost plus variable cost, or at the break-even point you can equate these total cost and total revenue separately. So the TC is going to be equal to FC plus VC per unit into the quantity. So total cost is going to be coming again from the number of units to be produced. Yep. An expression like this would do. And graphical representation is going to be something like this. So you can take the total costs on one axis, then you can maybe plot the variable cost also on another parallel line. This has to be parallel, be careful. This is going to be VC, and the FC is going to be in a x-axis parallel straight line like this, and this is the TC. Be punctual to name the axis always, cost and the units and the 0 point. Yeah, good for a 5 marks. Part number 3. How many tea packets does the firm have to produce and sell in order to break even? How many tea packets does the firm has to produce and sell? Okay, simple question is asking for the break even point. The hint is also given. break-even point, identify the minimum level of production and of sales which is necessary in order to avoid a loss. So no profit, no loss kind of a scenario. So simple continuation of our argument, I can write an equation like this. Yep. At the break-even point, my total revenue is going to be equal to total cost. So the revenue is going to come from 500 into the break-even quantity. 500 is the selling price. Total cost, two components, 250,000 and 300 quantity into this 300 variable cost, and that is going to be uh, equated to total revenue and total cost at the break-even point. So Q, assuming this Q is the break-even quantity Q, I can take Q to one side. So there's going to be 200 Q on the left-hand side, 250,000 here. Take the division, your Q is going to be break-even quantity, 1,250 units. Yeah, same style of calculation, so nothing much to be discussed further. Question 4. The firm expects that FC, VC, and selling price of tea packets all to be risen by 5% in the next year. Okay, so all components, fixed cost, variable cost, and the selling price, everything is going to increase by 5% in the next year. And also to produce and sell a total of 100,000 tea packets. Calculate the break-even level of production and the total expected profit in the next year. So there are two approaches here. The first approach is you can blindly do the calculation. You take the all the numbers of fixed cost, 250,000, inflate this by 5%. Selling price, inflate this by 5%. Variable cost, inflate this by 5%, and calculate the new break-even point. But eventually, what is going to happen? At break-even point, if you just focus on this equation, we have written the concept as total revenue is going to be equal to total cost. Okay. So what is going to happen to both sides? This 500, 250, 300. So all these three numbers is going to be inflated by 1.05%. So mathematically, students, be very mindful. In an equation, both sides, if all the numbers are going to be inflated or deflated by the same amount, the other variables are not going to get impacted. The other variables are not going to be impacted. So I mean, if you are really curious, try to do the same thing and inflate by 1.05 and try to calculate the Q. You're going to get the same Q. So the answer is same break-even point. There is no change of units provided that all the ingredients are changed. But let's say the prices have changed, but not the fixed cost. So in that case, you can get this assumption. You have to redo this and get the new break-even quantity. Yep. So at the break-even level, expected profit is going to be your previous equation, total revenue minus total cost. But here, I am going to inflate this by 5%. Why? Because all the ingredients have now inflated. So I'm calculating the profit here. Now I have to take that inflated 5% value. So the revenue is going to come from I think the quantities are given as 100,000. This is the selling price of 500. This is my fixed cost. This is my variable cost per unit, and multiply that by the number of items. You have to get an answer close to 20.7 million like this. Yep, I think that's all I can afford to discuss the questions. I repeat that there are good questions, there are good styles, different styles of questions under the previous past papers. So I think last week also we just had a glance through on these questions, but the missing questions are from 2017 March onwards. I want you to try them on your own. There are a couple of good total questions, full 20-mark questions, couple of MCQs. Try them and get the answers. And if you're not really clear with any answer, you can always drop an email or request for an answer. I will just shoot it out. And follow my suggested answer for the 2015 September. I think that's a question on the GDP, which I have shared with you previously. Okay. Any thing to be discussed under, sorry, before we move the last half an hour for our next session. If you have any doubts on the modeling, I can, yeah. Can you show the answer for the lastly discussed question? Yeah, sure, hold on. Right. I think this is the question. Hope you have got the first part on the book value after the 5 years at 750,000. This graph is pretty much yeah, same. And for moving on to the last two parts, these are the answers. Part number 3, break-even units are going to be 1,250, and the expected profit for the last part is going to be 20.7375 million. You calculate the simple, yeah, welcome. Calculate the simple total revenue minus total cost, and just the matter of inflating that by 5%. Why did we do that? Because the question says all the numbers are going to be inflated by 5%. Okay, excellent. So I hope that was a very fruitful session. A lot of questions can be answered, although it's a very simple couple of theories to be discussed. There are no much of theories per se, like the multivariant and the probability. But I would say you can cover a lot of breadth on the exam paper, from simple mathematical arguments to all the depreciation, cost, volume, profit, demand, supply kind of questions. Yep. Try the rest of the questions and get yourself familiar. And hopefully, like the IBS staff mentioned, there will be a methodology for you to get the model answers downloaded soon in the website. Follow that also, so that you will be at a better position. But I should give you a bit of a warning. You better always try the question, even if you're wrong, even if you're not getting an answer, that's fine. But at least try to read the question and scribble down something on your own. Then you know, okay, you don't know the answer, or your answer may be somewhat different, or you're not getting anywhere. And then only you should, get the model answer. Otherwise, if you really, focus yourself to the model answer correctly, directly, what you're going to miss is the thinking ability. You're not going to argue. You're not going to go through the wording carefully. The classic question that we did on this moisture resistance dose and the normal dose. Look at the wording. Look at how smart the examiner can use the English wording for you to, get yourself confused. That 23,000 from 17,000, it has moved up to 23,000, and that 5,000 has reduced by 1,000. So you can get yourself a bit confused. So that's why I really want you to try the questions first, and then if it is available, look at the model answers also. Yep. So we will focus on our next topic for the last half an hour. It's a lengthy topic. It has a lot of breadth to be covered. We will start the discussion today. I hope the slides have been shared with you by the IBS staff. Yeah. We may only be able to come to a middle point of the lecture, so we will try to continue the lecture on the next week. Yep. Excuse me for a minute. Okay. So we are at the last three lessons, starting from lesson 9, 10, 11. This is the starting point of the most interesting part of the syllabus for me personally. This is why sometimes a couple of lecturers who taught me finance has indicated this statement. Any complex equation in the mathematical financial mathematics per se, can be explained by the concept of time value of money. It's a very important concept, a concept that you're going to miss in your day-to-day computation, in your personal finance. Let's say some of you must be having your personal investments by now. Some of you may be still starting. That's fine. Let's assume for a student who is having his or her own motor vehicle, let's say you purchase that at 2 million and you're going to sell that at 2.8 million. Now the vehicle prices have inflated and you're going to make a profit of 800,000. So is that value correct? Uh, the numbers I told you is 2 million and 2.8 million. Hmm? And you're going to make an assumption that you have made a profit of 800,000. But what are you going to miss here? If you did that on a day, if you're a vehicle dealer or a vehicle broker who buy a vehicle today and within 24 hours, if you sell it off, perfectly fine. I can agree. Okay, that is your profit. But what are you missing here? The point that you're missing is the time value of money. What is that? That is the time differential between your start point and your end point. You may have purchased that your first motor vehicle for a value of 2 million maybe 2 years ago. You are comparing that 2 year value for a value that you sold today for 2.8 million. So what is going to happen to that 2 million? Hmm? Are you going to inflate it? Are you going to multiply it by something? Are you going to do some mathematical adjustment? That is what we are going to learn under this lesson, time value of money. So the concepts like compounding, discounting, present value, future values, all these have the similar, very simple concept. The time that you're going to hold money is going to cost you. Is going to cost you. Okay, so that opportunity cost, that cost that you are holding the money should be compensated in order for you to compare something, or in order for you to compute some sort of a net value for your project. You have some negative cash flows, then you have some positive cash flows, but at different times. If it is at the same time, we are happy. But at different times, year one, year two, year three, anything could happen in between. So those timing has to be compensated in order for us to do a comparison. The famous discussions between your parents and yourselves may be comprising of discussions like puta dua, uh, we had some basic salary of 300 rupees, 3000 rupees, and back then a loaf of bread may have been 3 rupees or 2 rupees. Why could travel from Mount Lavinia to Fort, for a value of maybe 1 rupee and 50 cents. So what are all these numbers? Those are very interesting, important numbers. What are those numbers? I mean, in my case, whenever I hear a number like that, I really, do a back calculation in my mind and see, okay, so that is in 1980s or 1970s. What has happened to the inflation? So the salaries, the price levels, when we discuss the indexing also, we learned everything has inflated. So that itself is going to show you the money that you hold sometimes ago, that number is not the same number as at today. So you have to learn the concept of time value of money in order to treat money the same way, in order to equate it in the same way. But bear in mind, this is not a perfect argument per se. There is no unique perfect argument saying that for one particular year, this is your opportunity cost, or for one particular year, this is the interest that is foregone. It's going to be very unique from a person to another person. But we want to do calculations in mathematical world, finance world, and take decisions. So obviously, like in any other lessons, in here also we're going to take some broad assumptions of the cost of money, and the inflation, price levels, and make our decisions. So bear in mind, although we are going to find answers for a lot of missing pieces in our knowledge in finance, but this is not going to be a perfect methodology. So there are some advanced methodologies in finance which are stemming from these present value, future value discussions. That is going to be the perfect calculations. Yep. So this is going to be the coverage, the expected coverage for the lesson. We will learn the future value and present value at two different areas. But First, we need to understand the future value. As at today, if you invest something, what is going to happen for that money in the future date? And then you will be introduced to this concept called compounding. Compounding. It's a very simple concept of compounding interest from a period to another period. And then this nominal versus effective rates is something which is widely used in banking and finance. So we need to understand the differences between these two numbers and to identify how to equate different returns. One return may be 3 months, one return may be 1 year, one return may be 3 years. How do you compare these numbers? That is the expectation of the areas. So annuities and perpetuities are going to be the next on the line before the present value, which is going to tell you what is going to happen for a series of similar cash flows. Series of similar cash flows. You take it up until the finite time, we call it an annuity. It goes until infinite time, we call it a perpetuity. Yep. So this is the first part of our expected subject car, and then we will take a backward looking and learn what is present value. That means you take a historical set of cash flows and take a present value as at today. Yep. Then we will learn what is the net present value. It is nothing but the expected value on a particular day after a particular time period. Then lastly, this NPV and IRR are two adjoining concepts going in side by side. We call it IRR as the point where the NPV is going to be equal to 0. You will learn what is NPV first, and then you will learn how to calculate NPV. There's a small r or a percentage component in it. We call that as IRR. And then at the point where you're going to get the similar to a break-even point of no profit, no loss, there's one particular point of negative NPV and positive NPV. You call that point as IRR. That's the breadth of the coverage of the subject on the time value of money. With that introduction, let's move on to our subject area. Right. This is the blue color text is the argument that I said at the beginning of the lecture. People would prefer to have money at present than in a future date. People would prefer to have money at present than in a future date. What do you mean by this? Let's say you have a business and you have 100,000 right now from the sales. Do you like it now or no? You have 100,000. What can you do with 100,000? That our exam question suggested that you can buy some t-shirts, some wristwatches. Likewise, you can consume. If you want to, you can consume. One angle. On the other angle, let me write that down since it's relevant. If you have it at present, either you can consume. On the other angle, you can invest. Maybe at 5% for 3 months. Example. And get a return for your 100,000. But can you do that if you don't have money right now? You really can't do it. So that's why. So compare this case. Now you have that 100,000 now. You owe that money and you got that money right now. So either you can consume, you can buy that wristwatch, KFC burgers, whatever you want, or you can invest. But in contrast, students, what if you get that money after 3 months' time? What is your position? I mean, you can do the same thing. You can consume, you can invest. That's fine, but not right now. But at a future time. So eventually, what you're going to do is that you're going to lose some opportunity. From the point of view of invest, you're obviously going to lose some money. Isn't that so? Why? If you have that right now, you can put it in a bank, put it in FD, put it in a savings account, put it in a treasury bill or a bond, anything. You can get a return. So if you get it in a future date, you're going to miss that return. So that's the simplest argument of the time value of money. It's going to say I mean, the concept is built on the notion that people would prefer to have money right now than in the future. Yep. Second bullet point. Provided all other factors remain same. Provided all other factors remain same, the concept of time value of money depicts that people always prefer to have money now than in the future. There are some factors to consider. So we are going to assume that all these factors to remain same. Now, in such circumstances, this time value of money concept is going to say that money now is always better than the money in a future date. Yep. Third point. Hence, 100 rupees at present is not going to worth 100 in future date, where it arises the concept of cost of money or the interest. So this is the birthplace of the word interest. Interest. Why? I mean, in simple terms, go back to point number one. If you have 100 rupee right now, and if your future date is after 3 months time, let's say at 5% for 100,000, 3 months you're going to get let's say 1,500 rupees approximately. Doesn't have to be perfect. So earlier you had 100,000. So the same 100,000 is being promised to be given to you after 3 months time, but only 100,000. Now what's the difference? The first instance, you're going to get 100,000, and after 3 months, you are going to have 100,000 plus 1,500. So that means 100,000 has been converted to 100,000 plus 1,500. But in the second instance, you're going to just get 100,000. So eventually, you have missed this 1,500. That is the cost of the money. Cost of the money for the time period of the period under consideration, for the time period. Okay, and that is the word interest is being called. You have some money with you. You have the rationally investment rate. Typically, it could be the risk-free rate, bank rate, average prime lend, deposit rate. It could be anything. It could be any interest of your preference, and that is the opportunity that you're going to lose. Okay. Last point. Time value of money suggests that cash flow should be always compared based on their present value to portray a fair comparison. Present value. Fair comparison. What if you take your 100,000 odd salary or 200,000 odd salary and try to compare that with your parents' salary in 1980? They had 3,000 rupees. Let's say in 1980s. Can you compare those two numbers? You really can't. Why? Because the timing is different. Those are two different time points. Inflation comes into play. Things have become more expensive. You put up an index and see your index value may have marginally increased over time. So after 30 years, that 3,000 rupees may be even more than 200,000. Yeah. So if you are to compare cash flows of your father's or mother's salary or the business income, could be anything, versus your salary that you're getting right now, you really can't do it. Students, you have to factor the present value concept and then only do a fair comparison. That is what we're going to learn. Right. So these are the ingredients that we discussed a moment ago. The first one, you prefer to consume right now. That's the rational human being's expectation. And inflation, what we discussed, will decrease the money value. Over time, if you have 100 right now, over time, it is going to cost you more. That 100,000, it became 101,500 after 3 months. So if you are being given the same 100,000 in two different times, right now versus sometime after, it's not going to be worth the same. So due to inflation, due to cost of money, due to interest, the money value is going to be changed from right now to the next point. But those are typically developing economies like ours. But what about countries like Switzerland, Japan? What about these developed countries? I mean, do you really see some major differences of price levels or major differences of salary levels? Obviously, students, those are some states where they have very strong currencies. Could be US dollars, could be Swiss franc, could be GBP. Unless that they are going through a turbulent time, like the Britain is facing now with the Brexit, or Japan sometimes back with the natural disasters, unless otherwise that they're going through tough times like that or turbulent economic conditions, the currencies are pretty much strong and the inflation are at a very lower level. That means the price levels are typically very stable. There could be inflation of 1% or even less than that, maybe 0.5, 0.2, likewise, very low levels of inflation. So obviously what is going to happen? The time value of money is going to remain pretty much same. Hmm. When the inflation is very low, the interest rate structure is also going to be very low. So although you get maybe 10% or 5% for your 1 year deposit these days in a country like ours, if you go to USA, you will barely get 1% or 1.5%. Why? The economies are stronger, inflations are lower, and the interest is a function of inflation. So typically, they are having very low levels of inflation and interest. So those countries, if you discuss the same concept of time value of money, over a very shorter to medium term, you may not see major differences of depreciation of your value. But with a higher inflation and high interest rate structure, obviously you see the time value of money is going to vary significantly from one point to the next point. Third point, what we discuss, I summarize here, the uncertainty. Hmm? If you have 100,000 right now, you can consume all those things. But what, unfortunately, what if you, get a disease like the COVID? What if you met with an accident? What if you, go through some bankruptcy? Then after some time, after 3 months, you are not getting the opportunity to enjoy what you could enjoy 3 months before. Isn't that so? So always today is the day which is in certainty. Tomorrow and the day after tomorrow, the month after, all those are uncertain times. So obviously, it is going to be another ingredient for the time value of money to come into play. Last point, the opportunity cost of money. So you have money which you can invest right now and get a return. If you don't have it right now, you're going to face some opportunity cost. You're going to lose that 1,500 for the 100,000 if you get that money after 3 months. So these are the factors to give the concept of the time value of money a an equation into light. Right. The first discussion set is going to be on the concept of future value. Future value is very simple. It's going to tell you what is the expected future uh, amount of cash flow which you're going to get, provided that you're going to invest this money at a particular rate for a particular time period. Simple as that. Look at this uh, simple timeline. This T is going to be equal to 1 year, 2 year, 3 year, likewise. So what is this return that I have mentioned in below is the 10% that you see here, and the period is 1 year. That means this 100 over right over here, this 100 rupee over here, after 1 year is going to convert it to 110 rupees. If you have the same interest rate, it's going to go to 121 and so on and so forth. It's going to grow. So the future value is the value in monetary terms of which were growing at a specified rate for a specified time. Specified rate, specified time. Yep. Sorry, it's red color. Specified rate at a specified time. Simplicity sake, we can always call this as a simple interest rate of maybe 5%, 8%, and timing is also from yearly basis, 1 year, 2 year. You don't really mention 17 days growth, 19 days growth likewise. So typically you discuss in week, month, quarter, semi-annual, annual kind of returns. Otherwise, if people start discussing their returns in odd numbers of 290 days likewise, it's going to be very much difficult for us to do a comparison. So the simplicity sake, rates are could be numbers, time are pretty much weeks, months, so on and so forth. So when you put this scenario in an equation, this is the simplest form of our argument first, which is going to build. That is going to be future value is going to be equal to present value 1 plus r. Present value 1 plus r. So what is this present value? This present value is the 100 that we saw. This is that 100. What is this r? That is the 10%. So how do you come to this 110? Is by taking the 100 into 1 plus 0.1 or 1.1. That's how you get 110. Simple. So this gives you the idea, okay, after 1 year time period at a rate of 10%, my current 100 rupee is going to worth 110 rupees. So this 110 rupees, students, is the value that we are going to call it as the future value. This is the future value. What about this 100? That is a value we are going to call as a present value. The R, the simple R, I mean, in different equations there are R, there are I and different forms, but mostly you can see the literature, the word simple R is the usage for the interest rate in the present value future value equation. So the simplest form of this combination what we discuss on the present value future value is going to be future value is going to be equal to present value to the 1 plus r, assuming that this is going to grow at a simple interest rate. No any other cash flows, your 100, 10%, 1 year, 110. That's on the future value. Yeah, so this is exactly what we discussed. Let's say interest rate is 10%, the future value is going to be 110. So in the event 110 above is comprising of the principal of 100 and an interest of 10. That is how we get the interest portion of 110. 100 plus 10, 110. So this is known as the simple interest. Simple interest. You get a principal and then you got an interest onto that. And what is going to happen? What is going to happen to this next portion of interest? Does it always going to come from this 100? No. Now, instead of 100, you have 110. You have 10 rupees also. So when we receive interest for more than one time period, in this example, we are going to discuss time period as 1 year. More than one time period. It could be month, it could be week. So here I'm going to just define your interest period is going to be 1 year. So when you're going to get your interest more than one time period, the concept of compounding comes into play. Compounding, or simply we call it interest on interest. Valpolia, interest on interest coming into play. So that's why when you take the next point of 110 multiplied by another 10% is going to get another excess return of 121. Look at this set of computations where you can see the value of interest over interest coming from. See, our initial investment is 100. That's fine. After 1 year, we are here. Now this point up until here, we can clearly understand. So what about this 121? How do you get this? You get this by taking 110 multiplied by another 10%. So in reality, if you really look for the composition, this 121 comprises of 100 for a period of 1 year, for a period of another year. Yep. So you are getting 100, 10, and another 10. So what about this one? That is coming from this first 10 that you are getting another excess 10%. That is another 1. Typically, this is your first interest on interest is going to come into play. Similarly, this 133.10 also you can decompose it. 100, 10, 10, 10. Then you are getting 1 rupee excess. Then this excess 1 rupee is going to get another 10 cents. But what about this 10 rupee that you earn here? That is going to get invested for another 2 years. So likewise, this 133.10 can also be decomposed from your principal and the interest components that you got from period to the period. Okay. So the compounding is assuming going to reinvest the intermediate interest payments on the future period as well. Future periods as well. But this is one of the weaknesses in this model. Why? Here, I mean, unless otherwise it is being presented by bank interest or a bank scheme or a loan scheme, here you're going to make an assumption that your intermediate cash flows, this intermediate 10 rupee cash flows are going to be also reinvested at a rate of 10%. But in reality, in real world, in project appraisal, in your personal life, could be a different reinvestment rate. Because why? After 1 year, this 10% of per annum return may no longer be there. Sometimes it could have come down. So after the second year, it could have gone up. So in reality, when you do this actual cash flows after some time, this computation is going to be somewhat differ. But that future is unknown. So we can't rely on an unknown future. In finance and mathematics, we always take an exam, some sort of an assumption, then we move on. So here, the broad assumption is that we assume that we reinvest the intermediate cash flows also at the same rate of interest. Yep. Okay. We will stop our class with the discussion on this slide and try to move on to the next couple of slides from the next point on. But merely since we came up to this far, let me just take up this point and finish it off with the global definition of our present value future value equation. So here what I have done is, instead of these 10% and 1 year, I am going to bring up some mathematical numbers here. Typically, the number of years to be taken as n is the only addition for our previous discussion. Future value we discuss, present value we discuss, 1 plus r portion we discuss. But here only difference is you introduce this value n, simple n, into the picture to say, instead of 1 year, you can take n number of years, n number of future years, and calculate the future value. For instance, you want to calculate 100 rupees after 7 years. So the future value of 100 after 7 years is going to be 100 equal 100 multiplied by 1.1 to the power 7. So this is going to give me an answer. If I quickly do the math and see, 1.1 to the power 7. After 7 years, my 100 rupees, assuming that I reinvested the numbers at the same rate of 10%, it is going to be equal to 194.87 rupees. So this is the global equation that we discussed at the beginning of the discussion. So remember, when we discuss the present value, all what we are doing is we are going to take the present value into the subject of the equation. Present value is going to be equal to future value. This portion is there, and this 1 plus n to the sorry, 1 plus r to the power n, you take it to the bottom of the equation. So this is the simplest form of the equation in finance that we discussed for the present value and future value. So remember this equation. This is a very important equation, and you should know this without the confusion. You shouldn't say present value equal to future value something, or some sort of a different equation. Always try to go from future value first. Future is always going to be present multiplied by some number. It's not the other way, isn't that so? 100 rupee right now is going to be worth more than 100 rupee in the future. So your future is going to be equal to 100 multiplied by some number. So this part you can not forget at any time. So then you can argue for the reciprocal. The present value in that case is going to be equal to future value divided by 1 plus r. Later on we will discuss in the next class. This we are going to call it as a discounting factor, and there are different combinations of this 1 plus r used in different instances. Okay, so this is for the r rate in period of times, the future value equation. So what's the future value for 500 rupees after 2.5 years? You take the 250 at 1 point, let's say 13%, 1.13. Period is going to be 2.5. Simple as this. For half a year, 0.5. So this n, you can play with the n. You put per annum returns for the periods accordingly. I think that's all we can cover up to now for this week, and we hopefully from slide number 9 onwards at a rapid pace we will try to cover on the next class, and hopefully move to the next theory areas also. So thank you for your time, and I can wait for a little further if you have any questions on our modeling or any doubts on the theories that we discussed so far. Okay, excellent. Thank you, everybody. I just really want you to try the rest of the questions on the ones that you missed. And if you have any particular interest, let me know. I'll try to share the model answers with you separately. Okay, then I'm going to sign off. You all have a good day and stay safe.